Hello, welcome. I'm Jay. This is smarthelping.com, and I've got a new financial model here for you for a laundromat. It's got some great logic in it. I've actually cleared the template out, and I'm going to fill it in so you can see how all the assumptions need to work, and I'll talk to you about it as I go along. And this is how the template will come when you purchase it, with everything blank. And again, you can follow along with me as I actually fill it out. Um, so it's a 10-year model. You can look at the index tab to get a general overview of what's on each tab. Global controls where we start. So here, company name, I'll just say, Laundro123. Launch year, I'm going to pick 2020. I'll pick 2024, I guess. That's going to be next year. End month, I'm just going to run it for a full 10 years, but you can pick any length of time, and that is completely okay. I'm just going to pick December 2033. Include terminal value, I'll say yes there. Sales multiple, I'll say 120% of sales on the exit. Um, so this is interesting now because I usually don't do these overviews like this. So for cash sources, I wouldn't fill this out yet. Tax rates, you can just put an income tax rate and a capital gains rate in here if you want. If you don't want to show taxes, you can always just keep these zero. So that's the first tab. Now we go over to the main machine configuration. So this is if I'm going to buy a laundromat. What I did here is allowed for 5 different types of washers. And these 5 actually are important to be washers because they're linked to the utility water bill. So these top 5 are used for that. And then everything else has electric is applied to all these. And then I think we have another variable cost. Oh yeah, repairs and maintenance per machine. So those, just make sure these top 5 are things that use water if you put anything in here. So I picked the month of purchase. My drop down is going to be based on what my launch year was. So let's just say we're starting these in maybe March of 2024. We're going to buy these and put them in service. Maybe we're just going to do 3 different types. We'll do maybe 8 of these, 10 of these, 5 of these. So 23 cost per unit. Usually, these commercial washers can be $1,000 to $3,000 to buy. Let's say this one's going to be a lower end, maybe 900, and maybe this is a little bit higher end, 1,500, and maybe these are 3,000. Okay. Um, Also, let's put in a couple dryers here. Same month we'll pick for each one, and maybe we'll do dryers. Maybe there's a little bit more of this type, and then maybe the rest are this. Maybe there's not a third type for these. And then cost, we're just going to do 1,200 and 1,100. Now, I need to do price. So how much are you going to charge for people to use your washing machines each time? And so let's just say it depends. I'm just going to put $3.20 for these. Maybe this one's a little bit more, $4. Dryer, we'll just say maybe $3 for each of these. Also, the price increase, we can say on average, maybe it goes up by 2% per year. Now, max hours available per month per machine is its max capacity. And what you would do here, the easiest way is to say if you're open, let's say on average, 30 days a month times if you're open, say 14 hours a day, then in a full month, if it were being used 100% of the time, it'd be 420 minutes. So we'll put that capacity for all of these for 20. Now, average time per use in minutes. I don't do a whole lot of laundry, so I didn't know. I asked my wife, and she said sometimes loads can take, 2.5 hours. Um, and that's basically, so 2.5 hours you charge the customer $3.20. So if that would be the case, you'd go 60, another 60 is 120, and then half of that, 150 minutes would be 2.5 hours. So maybe it's 150 minutes for these. And it could be different, just depends on exactly how your machines work and everything else. But so based on the average minutes per use, the total hours available per month, and the machine count, I can see here this is my maximum washes that can happen in a given month, assuming it's used 100% of the time. And we'll get to utilization and seasonality here in a second. But yeah, so 1,300 washes a month is the maximum for this tranche of 8. Now useful life, we'll just put 7 years for these. This is only for depreciation. It doesn't affect anything else. We'll also go here, let's say maybe in January we purchase all this other stuff. Possibly a vending machine. So a vending machine is going to be like 3,000. Tables aren't going to be a whole lot. Maybe 3 tables, $20 a table, or maybe 50. Depends on what kind of tables and chairs. Maybe 15 chairs at $20 each. Not a whole lot there. Coin changer. I think these were like I can't remember. I think 900. Do oh, 900. One of those. And then soap dispenser. I don't think that was a whole lot. Maybe I can't remember off the top of my head. Oh, maybe 3 of these. $100. I can't remember. You'll have to look all this stuff up for your own strategy, but I'm just showing you how you'd put it in here. And these are CapEx items down here, so we give these useful life as well for depreciation. Ancillary income, so this would be like things like the vending machine and detergent, or if you're selling anything else. So what you can put is on average per month, what do you think you're going to make an extra income from those things? Maybe 2,500, and then expected margins. Let's say you make 35% margins. Now you can see as I'm filling this stuff in, I'm getting data here in the financial summary because this is where you're going to spend most of the time configuring your strategy, timing, the count, the pricing, utilization. So after you do that, you can see here this financial summary is going to show you your annual revenue, OPEX, CAPEX, debt service, everything, cash flow, and IRR of the whole project. So here we actually have a positive 8.5% IRR with just the ancillary income. This 30,000 is just from this number we put in here. But let's put in our utilization for the machine. So this is seasonality and utilization. So we could say, let's say year one, out of this full 1,344 max washes, if it was running constantly every, for the whole time the laundromat's going to be open, it'd be 100%. Let's say it starts at maybe 60% of the time each machine's being used. It could be more, could be less. And then maybe in certain months, like this is January, February, March, April, May, June, etc. These represent the months of the year. And then this represents the year of the model. So you've got a full 120 months here. Let's say maybe in May it gets a little bit less busy. People are doing their laundry outside or whatever. I don't know. And then maybe you pick back up in August. A little bit more September, October 70%, so maybe 80 here, 85. All right, so there's my seasonality and usage of the maximum potential washes. And this applies to everything equally, all these types. And then we have an improvement. So you could say, well, if you're just starting out, maybe you have in the first year a 5% improvement across the board, and then maybe a 1% improvement in utilization, and that's kind of where you even out. So we just zero out the rest. You can see how our financial P&L has updated here accordingly. And we're up to 210% internal rate of return. Pretty good. Okay, so that's the machine configuration. Revenue matrix automatically populates. This is how all the logic is happening for everything that I just input, so it works correctly. No inputs here for except for if you wanted to see average uses per hour per machine, you could put this in and just see. These are like sanity checks to make sure what you're entering makes sense. Average revenue per day per machine, uh, average uses per day per machine, average revenue per month per machine, average uses per machine per month, and then revenues, use washes, dries, maximum washes, all that. So you can kind of do a sanity check on what your assumptions are to see what it boils down to over time on this tab. Running costs. So here, let's say we're not renting, so we're not going to fill anything out for this one. Maybe there's a manager, 2,500 a month, and maybe this goes up a little bit, so 2,575. Franchise fee will put 0%, but if the laundromat's a franchise, you might have to pay a fee on your revenues or some percentage. You could put that there, if so. What else do we have here? We'll definitely have like legal and accounting. Just start that right off the bat. Actually, we'll start this in, yeah, that can start January, March. You could lease your machines if you're not buying them, and that you could account for that here. And then if you were doing that, you would have to enter the amount you're buying here and just put for the cost 0. And then you'd put your rental costs here. Office rent maybe 3,000. We'll make that go up a little bit. What else do we have here? Just other items. Oh, let's put in the cost. So maybe this is 250, maybe 300 a month, and 1,000, and then maybe licenses, maybe 150 a month. These are just fixed costs. You can determine the start month, the monthly cost in each year, and the description of that. Now, variable costs, very important here. So repairs and maintenance cost per machine per month, probably not a ton, but on average, maybe 30 bucks. And it could go up over time, assuming the machines are getting older, they need maintenance. You've got water costs per machine per month. I don't even know, but I'm just putting in a number here, maybe 40 bucks. So that'll apply to each machine. And maybe that goes up a little bit as well. And then electricity, same deal. Maybe this is 35 or maybe 45 per machine. And that will scale as the machine counts, depending on what you put in this machine counts. Okay, cap table. Yeah, we could do this now. So we'll just put total shares. You can just default it at 100. Oops, this should not have a $sign when I did my formatting here. So we put 100 there. You could just do all common shares 100%. And then you could put outside investors and inside investors. I normally just leave all these blank and just do a default overflow. This will take any cash from this initial investment that hasn't been populated anywhere else, and this is the remainder that you still need. And you determine the percentage of common stock. Let's say you have maybe an owner putting in 50,000, and then the rest you got 27,000 from an investor, and you're giving the owner 80%, investor 20. Now, if it's not a joint venture, there's no investors. What you can do is just zero this out. You just zero this out and this, and you just put this at 100. And this is essentially, even though it says outside investor, that's okay. Just let this be the default and give it 100% equity, and you just know that's the only entity in the whole group. So these are all the cash flows of the whole project right here. But we're going to do a joint venture. We'll say, well, let's say, so our initial cost 77,000. Now you could also do it this way where you copy, paste values to the exact amount, and then you have no outside investor and you're doing 100% of this, like this. That's fine too. But let's say you're gonna do 20,000. Investors will do the rest, and they're gonna get maybe 40%, maybe 30. So you get the other 70, and this down here, these will be the amount remaining, which should be 0, 0 if you're using the column, or 100% on these if you have not used these at all. Okay, you can see their contributions, distributions here, and IRR. So this is the cap table. CapEx. So since we are, okay, this is actually going to raise those costs a lot because I said we're not renting. So we're buying the building. We like real estate, so we're going to buy this. Let's say it's, I don't know, maybe 400,000. Put a useful life in here of 30. Let's say we're buying this in January 2024, and let's say at the exit, maybe it's worth 500,000. You can see all your other CapEx items automatically populated in here from the machine configuration. All right, so we have this. That's fine. Now you can see our costs just went way up on the cap table. It's now 476. So let's say maybe now the owner's going to do maybe 50,000. You get 426,000 from investors. So that's just from the building that went up that much. Okay, terminal value. The only thing on here you could really do is I usually put 95% or 100% here. If you put 95, it just says on the exit how much of the exit value is going to apply to this as a gain on capital, like capital gains, rather than extraordinary income. But if you don't want to worry about it, it's not a huge deal. You just put 100% there, and then these will just all be 0. The building is still a separate item by itself, governed by whatever you put here. But these will apply to all the other CapEx items, this percentage. And then you can also see the total 12-month trailing sales revenue, the multiple, the resulting valuation, and then also the value from the building. We're not putting any into the CapEx, so it's just all extraordinary income and then the sale of the building. So this is your total exit. Startup costs, maybe you do a website, 20,000 to get it launched. Maybe one-time consultant fees, 5,000. Maybe you want a reserve of 25,000. Reserve just means when your cash in the forecast is 0, you actually technically would have this amount left because it's accounting for this in the initial investment. Now we put that in there, you can see the cap table went up a little bit more now for the cash required after we put that. Debt schedule, so now is the point where you go back to the global control. You can see your total equity required here. You can say, well, I think I want to get out maybe a $100,000 loan, SBA loan or something like that. You could put that in here. That will reduce the equity, but it won't until we put in a date. So we have to put in our date here. Let's say we get that loan in January, 30-year term, annual interest rate, and 12 payments a year. Then you go back here, now you can see our equity went down by about 100,000 roughly. And now we have debt as well. So that'll flow through the model, and that's assumed to be paid back if you include the exit value. If you don't, it'll just run to the just to its life, and you'll see the effect of that through the 10 years. Okay, so that's all the assumptions. Now we have income statement. So this is showing you what revenues you're making over time based on all those different assumptions for the whole 10 years. Variable costs, you can see your repairs, water, electric, other ancillary costs of goods sold, gross profit, operating expenses. Then you see EBITDA, interest, depreciation. You can see taxable income, net income, You can scroll over here. Here's the exit value when you sell. If you wanted to include the exit value, it'll pop in here, and you can see the taxes on that as well for that month. Income statement annual, same deal, but on an annual basis. Balance sheet, you got your cash is your only short-term asset. You've also got your capital assets, building, all the washers, any other CapEx items will come in here. You've got accumulated depreciation, total assets, liabilities, just that one debt item, the debt schedule, and then you've got owner's equity is outside, inside investor investments, common stock, retained earnings, total owner's equity, liabilities plus owner's equity always equals assets. So you can see this is the check to make sure the logic's all working, which it is through the whole time. So that updates as you input all the different assumptions. Balance sheet annual, same deal, but on an annual basis. All the same stuff as the monthly. Cash flow statement. This is kind of like your sources and uses a little bit. You can see here's the cash from operating activities, investing activities, and financing activities, and then the net change in cash per period. So you can see here we have 52,000 in negative cash flow for the first month. This is mainly because of those initial startup costs for that we put on for the website and stuff. CapEx is all the building, I think, mainly, and then the 71,000 when we buy the machines in March. Here we have debt, borrowing, and then we got revenue, or not revenue, but investment from investors. So all this is connected with the balance sheet, income statement, and cash flow statement. These are all connected and balance out. Here's the annual cash flow statement. You get a nice view of all the items. Visuals, we've got a 10-year financial analysis that shows revenues, gross profit, and EBITDA per year. You can see 10-year expense summary by type of expense, variable costs, sales, general and administrative, and franchise fee if applicable. Yeah, frog on my throat, sorry. Total machines by type. You see that here, each of the different types of machines you've got and the total count of them. So you got just over 50 annual uses by machine. So how many times each machine type is being used over the course of a year across all the machines. You've got annual revenue by machine type, average annual EBITDA per machine. So how much is each machine on average producing in EBITDA? Your monthly cash flow, your cumulative cash flow, your gross profit per year, and your gross profit margin per year. These all are going to update based on the assumptions. Distributions, this is your discounted cash flow analysis. So you've got your initial investment here, and then the resulting cash in or out over time. This is really nice and dynamic. It'll handle any cash flows up or down over time and give you the right, not double count anything. And this actually took me quite a while to develop this style of doing it, but it works the best for the most amount of use cases. But for here, it's pretty simple because most of the money's coming out in the first couple months, and then you're running a profitable business after that. So you've got your initial investments, and then the resulting distributions. Now this is saying the project as a whole has a 19.7% internal rate of return. Let's say I put a discount rate of 10%. That gives me a net present value of 300,000 roughly, which is just taking the present value of these cash flows against the initial investment. Now, if I were to use the IRR into this discounted cash or discount rate, the net present value would be 0. And that's because the IRR is actually what you have to discount the future cash flows at, so the net present value is 0. That's what the IRR actually tells you. So there's a link there. That's why I always put it with the discounted cash flow analysis. Then you've got the investor view. So here's what they're getting. They're getting a 1.9% internal rate of return, not too great. They're getting a 30% share of all the cash flows. The owners got a 94% IRR, and they're getting 70% of the cash flows. And you could do discount rate for them as well. So it's going to be negative if the discount rate is higher than the internal rate of return, then you will have a negative net present value. So maybe in this case, you'd give the investors maybe for this investment maybe 45%, and then these owners 65. Make sure that's put in too much, 55. There we go. And now 7.8%. That's a lot better. That's good. Okay, executive summary is just high-level details, revenues, expenses, EBITDA. You can see debt service coverage ratio here, average EBITDA per machine. Other cash flow items, CapEx, debt service, all these other items. You can see the total cash flow after tax here and the cumulative cash position. And then we have project IRR, equity required by the project cash returned, equity multiple, and then the project ROI. And you can see that also for the investor view and the owner view. Monthly detail, this is kind of where everything comes together, and this data will feed everything we just went over. So total machines, the monthly uses, here's your revenues, ancillary income, total revenue, here's all your variable costs, franchise fee, SG&A. Oh, I didn't even put marketing costs in here, so I probably would want to add that in, maybe $2,000 or $3,000 a month for this kind of operation. Then you got your EBITDA, debt service, other cash flow items. So that's the model. Is pretty comprehensive, but not too scary. There are a lot of tabs for reporting, but the inputs are not too bad. I went through all of them with you, so you could see how that worked. The main one obviously is going to be the machine configuration. Then everything else is kind of your and running costs, and then everything else is just kind of how you're financing it, exit potential. Now that we've filled everything out, you can go back here and see the financial summary on the machine configuration, tweak things and see how that changes this. Global control, you can see all these checks are 0. That's good. They always should be 0. You could change the end month and it all balances out. You could not include the exit value, still works fine. Okay, so that's the simulation. I hope you like the new style of me going through this where I'm actually filling it out with you. I think it's going to make the model much more useful and user-friendly. You'll be able to buy the template. You can click through the link below in the description box. It'll be $45. You could also, I'll probably list it elsewhere because I have a couple of vendors, but links in the description box below, and I'll see you guys on the next one. Don't forget to like the video and subscribe.